All right, let's dive into a couple of things here. Avoiding common traps for a smoother retirement journey. And there's two here on this list of five that really stick out. Number one, strategic Roth conversions, a tax efficient strategy. Number two, tax diversification, spreading your financial risk. Number three, withdrawal sequencing done right, minimizing tax burden. Number four, qualified charitable distributions. Number five, Social Security timing. We talked about a bunch of those earlier on in the show, but let's talk about number two here, tax diversification. We'll talk about number three in a moment, but David, tax diversification, spreading your financial risk.
Yeah, and I think, Jim, this is the most important one by far, because the majority of people and then turning in that retirement age have tax qualified assets, right? IRAs, TSBs, 401ks, 403bs, right? SEP IRAs, right? So when you look at these, right, it's basically an advantage to be able to really tax defer your growth. Okay. And why that is because you have that triple compounding effect. So that's what really starts the retirement phase. Okay. And those of you out there, again, I know we talk about it a lot, but those of you that have those qualified assets, Roth IRAs, TSBs, 401ks, you name it, please reach out to us. That's one of my specialties. That's Steve and I. We go over probably 5 statements a day just on these specific assets. And why they're so important in retirement is because when you actually transition, and on an earlier episode, we kind of got into this, you really have to understand how to be able to utilize them tax efficiently and for income efficient. Okay. So being able to plug in these things and being able to use them, right, to be able to not pay taxes on them at first, right, you get your tax exemption down the road, to be able to use them down the road in their retirement field. Okay. Then comes using them. Okay. I'm going to go over 2 misconceptions that a lot of people have out there. Number one is, hey, I can just take it out and pay something off. That is literally the worst idea you can ever do. Okay. And the reason, and I'm sorry to be so transparent about that, Jim, but the reason is that obviously the higher your income bracket goes, the more you're paying towards the IRS. Okay. If I took an extra $100,000 out and I'm in a 32% bracket, I'm going to be spending an extra $32,000 in income taxes, right? Towards the state, towards the federal. You have to understand how to use that efficiently. Okay, so it's not the same as CD funds or checking and savings funds. You have to understand where those assets are allocated and how to take them out. I've heard that so many times that I really want to bring this up on the show. If you are looking at taking money or you are withdrawing out of your IRA, rollover IRA, 401k, 403b, you need to meet us as soon as possible. You need to set up a meeting with us. We will sit down and go over these things with you and help you do it efficiently, right? Because that is the main reason. Next, I'm kind of going to go over into that third segment. And this leads from the second segment, okay? The withdrawing sequence. Okay, so I'm going to give you a couple hints here that I think that really kind of open up some of these things and make you realize really fast how it can be more efficient down the road, right? You have to understand where your withdrawing comes from. Are you non-qualified or are you qualified? Qualified means the majority of the times that you have, tax deferred assets, right? When you take those out, it will be taxed as ordinary income. Okay. Yes, it does raise your tax bracket. Okay. So like I was talking about earlier, being able to maximize what you're taking out, what you already have in income, or let's say your Social Security level is, or other capital gains, 1099 INT, things like that, where all your gains are and what brackets you can go up to, right? That's one of the biggest things that we actually pull out is we find out that someone is taking out an extra $100,000. What they don't realize is they could have split 50-50 in 4 months, okay, in the next year. So you have to understand some of these things because you want to beat the system, right? And we always say that, and it's kind of a funny statement, but our motto is beat the system. Don't let the system beat you, okay? There are a lot of ways that the system can beat you, right? So you have to understand the strategies and really the mathematics that go into it, Jim, that I think down the road, in having some tax-free accounts is great as well. But there's a reason why the government puts limits on those tax-free accounts, right? You can only put a certain amount into a Roth IRA. Okay. And when you do a backdoor Roth or you do a Roth conversion, you have to wait a certain amount of years to be able to even touch the money. So your liquidity feature goes down. And everyone knows liquidity is one of the most important things in retirement. If you don't have liquid money or you're not generating an income stream, you're doing it all wrong. You have to have certain assets put away in certain allocations to be able to use for your goals down the road in retirement.